Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel, all the comments and subscribers. I greatly appreciate it. This week up, we're going to take a look at Disney, the giant, the behemoth, the entertainment company that's moving into subscription with their Disney Plus, the Hulu Plus, the ESPN. Let's see how much revenue, earnings, cash flow Disney is generating, how much we think they're going to generate in the future, and what this company is worth 10 years from now. And if we bought it today, how much money do we think we can make by buying the stock today and holding it for a decade? You ready? Let's get to work. All right, let's dive into Disney. Remember, read the 10Ks. I've pulled some 10K data here behind me. We're going to go through. I'm also looked at the most recent 10Q that they just released. Their fiscal year ends September 30. So I pulled the last quarter that's available, which is December 31st, 2021. Was the quarter, to pull the most recent subscription numbers that they had and to get a take on what COVID has done to the business and how much of the business has recovered post-COVID. Fortunately, they're saying in that release that a lot of the business is back. The parks are back, the cruises are back, which is very, very interesting. And when I run rate that number, it puts them close to where they used to be, but they're definitely not back to be 100%. I think there's a lot more that has to happen. We're going to dive into that in a second. What I do want to remind you about is this channel, we're dedicated to the cash flow, rational investor that buys pure hard money cash. We try not to speculate too much, try to capture that upside for ourselves, not bake it into the forecast, because then you're just buying that forecast. We want a nice, conservative, easy-to-hit target forecast out in the future that generates high return, and if they beat it, that's upside for us that we keep. Now, I want to review the 5 key attributes that we use in this channel to value all securities. Number 1, top-line revenue growth must be there. Number 2, earnings growth. We use EBITDA, enterprise-level earnings must be growing. Number 3, strong free cash flow. Number 4, low debt, less than 3 times debt to EBITDA. And number 5, a well-priced stock. Well-priced, what does that mean? That just means with a conservative forecast, we think it can outperform the market in the future. That's it. And we want to try to forecast every business on a conservative basis, and hopefully they outperform. And that is our upside that we get to keep. You don't want to have too much of an aggressive forecast because you are paying for that forecast with the purchase price that you buy into. So let's dive right into the Walt Disney Company. Take a look at what they've got. So the last nine years, 2013, they minted $45 billion of revenue, and they've grown that over the period of time, even through COVID, by the way. It's gone to $67 billion, slightly down from 69 at the peak pre-COVID. Now, they're saying that a lot of this money has come back into, or earnings has come back with the reopening of the parks. They were running at limited capacity historically during this time, but they've come back. So that's a good point. Let's shift over to profit. Take a look at EBITDA. Now, EBITDA is earnings before interest, tax, depreciation, and amortization. It's kind of a proxy for cash flow on the income statement. It's a bad one. Don't get me wrong. We're going to look at cash flow in a second. But this is a metric for earnings that is often used in investment banking and private equity. It allows you to look at kind of the run rate of the business, holding aside some of the large one-time issues that can affect the P&L on a year-in, year-out basis. And what you can see here is 11, 13, 15, 17, 16, 17, 18. They are growing that until they hit the COVID shutdown. And it absolutely obliterated earnings, halved the number for 2 years. Now they're saying that this number has come back, and I know when I run rate it, when I take December quarter for them and annualize it, I get about $12 billion of EBITDA. So it's definitely a step up. So next 2022, I'm saying $12 billion. It's definitely a step up, but it's not the 16 to the 17 that they used to do. So we're in this weird landscape right now with the economy and with a lot of the companies in the stock market where the stock investors are looking beyond COVID and they're saying, well, COVID, the shutdown, that is a temporary phenomenon, which I think everyone agrees it is temporary to some degree. But then they expect it to bounce back and be exactly what it once was. And I don't know if that's going to happen. We've got a lot of different economic conditions that are different now than they used to be pre-COVID. And at some point, you look at numbers that are less than what you used to be, and you say, well, where is the new normal? What is that new level? And I don't know. We're going to have to figure that out. But it's an interesting question. How many years of sub $18 billion of profit does Disney produce until that becomes the new normal? I don't know, but it's a question that's out there, and I think that investors need to take heed that the economy might not come back the way we think it did, and you want to make sure your portfolio is positioned that. So I'm going off on a tangent. Let's keep going, but it's just some food for thought that after a while, this does become the new normal, and we need to make sure that we're invested accordingly. But it is growing. If I hold aside these 2 years and I focus just down here, the growth rate prior to COVID, both revenue and EBITDA were growing. That's going to check our box for the growth rates. Let's look at enterprise value and figure out where they are and what happens. So the first thing we do is we always start with debt. You want to look at how much debt they have, especially in this rising interest rate environment. You absolutely want to make sure you're buying companies that don't have a lot of debt. And what you're going to see here is 14, 17, 20, 25, 47, 62, 58. That's a huge move in debt. Now, some of this increase is because of an accounting change rule that required companies to capitalize leases. Fine. But this is a lot of just borrowing because when COVID shut down, the company needed instant liquidity to make payroll. They draw on their available credit lines with banks immediately to infuse the business with the cash. Cash is the lifeblood, right? It's a moat. What protects the business from all kinds of other disasters. And so when something like this happens, everyone goes and taps credit lines, instantly pulls money to the balance sheet, regardless of what this does to their financial metrics, just to make sure they can weather the unknown. And then as time progresses forward and they understand what they need to do, then they can react accordingly. And I think that's what you're going to see. You're going to see them pay this down over time. In fact, if I look at the cash outstanding, the excess cash that I believe, they don't put their cash into the excess cash line that we typically use, the short-term investment line on the balance sheet. They keep it in one giant cash flow bucket. So what I've done is I said, you know what? I looked at their cash balance. It's like $5 billion in these years. I said, you don't need that much cash for this business. So I took out $1 billion of cash, just put it something. And then more recently, that number has absolutely spiked to $16 billion of cash. And I said, well, there's a lot of excess cash there that they can use to pay down debt that they're simply not using. They borrow it as a reserve just in case. Now, as they're understanding what they need to do to change and adjust the business, they're going to start paying down this debt with this cash. So I put it here to net these two. But it is higher than it used to be. I'll say that. Then market cap, 115 billion, 175 billion, 170, 200, and then 300 billion. So there's a nice spike here from say 175 to 300 billion dollars, which is very interesting. In large part, the lack of change in enterprise value as a result of the drop in earnings. One, means multiples are going up, but two, more importantly, it means the market is basically ignoring the pandemic and saying that Disney will fully recover. So I'm not willing to give any kind of discount for the stock today because the pandemic is a one-time deal. That's what this says. This giant increase in enterprise value with the decline in earning is the market saying it's temporary. I'm not going to discount the stock. That's market cap. Sorry, enterprise value is the sum of the debt less the excess cash, but the principle is the same thing. $200 million to $350 million. There's no drop here. And so when I go over to our valuation metrics and our debt metrics, let's cover the debt first. Debt was beautifully healthy. 1 times debt to EBITDA, 1.5 times. Very, very risk averse. We love seeing that. That's a great position. And then it jumps up to 5.3 times. Now, this is exactly why you want to make sure you have businesses with low debt to start before the pandemic. Because look at this swell that happened at the pandemic. If Disney was for say 5 times here, and then the pandemic happened and they had to pull on all kinds of debt coverage, this number would have gone to 9 times. That debt would have been much more expensive. it would have come with warrants or the right to buy share equity, which is dilution to us as equity owners. The debt would have been much more expensive, even if they could have gotten it. Some businesses can't get it and they go out of business. That is why you need to make sure you have a company that has very low debt, because when something happens, that something is too unknown. You can't then go get lines of credit. You have to have already had them established so you can draw on them immediately. And in this case, they were able to do so. They have excess cash here that they can pay down this debt, and over time, there's enough cash flow, they will buy this back down. So I'm not worried about it. But had they had the high debt to begin with, it would have been a completely different story, and it would have been much more detrimental to the existing stockholders if they had too much debt before the pandemic. So always watch that. All right, let's go to the valuation metric. So this is enterprise value to EBITDA. It's one way of saying, hey, what's the payback of this business? What's the total value, and how much annual earnings does it make? And if I divide the two, I get a ratio. Enterprise value against earnings. How many years would it take for the business to pay itself back if there was no growth? And what you can see is pre-pandemic, in fact, pre-subscription announcement business, put it that way. So before they said, hey, we're going into Disney Plus, before they started making some of the big acquisitions they were doing, they were in this 11 to 12 times multiple range, a very low multiple for such a big business. And their growth was kind of okay, mediocre. Then they said, hey, we're buying Marvel. This is 2019. And, oh, by the way, kind of in 2020, we're going into the subscription business. And look at the multiple absolutely jump 60%. It goes from 10x, which is what here for a long time, to 60 to 16. That's a 60% increase in a business, by the way, with earnings that didn't move. In fact, it went down. So they were doing $17 billion in EBITDA on $60 billion of revenue. Revenue went up to 70, good job. Earnings came down to 17, fine. But the multiple goes up 60%. So what happens is the enterprise value absolutely jumps from $200 to $260 billion. Not based on earnings, just based on the market demand. The expectation of future growth changed, the market reacted, and the demand for the shares increased, and people are willing to pay a higher price for a company with, in that instance, declining earnings. So I think that's a telltale right there that there's been a shift, and I think going forward, this business is not going to trade here. It's going to trade at a higher multiple. Just because of that subscription business. When you look at Netflix and those things, they trade at much, much higher multiples than 10 times. So there's the value of the subscription piece, I believe. And then here, this is COVID, right? This is basically saying the enterprise value, the stock market is not going to give any discount because of COVID. They're going to say, hey, it's one time, and earnings are going to collapse. The value of the business stays the same, therefore this multiple skyrockets. And I expect this multiple to come back down to this 16 level in the future when earnings stabilize. So we'll take a look at that. Let's go look at cash flow right now. Okay, here we are with the cash flow statement. Now, this is my personal favorite statement. It's what this channel is based on. It's a rational investor. The one that's buying pure cash flow, and we always want to smell check this because you can mess with the income statement. I mean, you're not supposed to, but even within GAAP, management has a tremendous amount of flexibility of how they set amortization rates, when they recognize revenue, and in doing so, there's some flexibility per quarter. The cash flow statement you can't do. Cash flow statement is auditable. It's easy. They can pick up the phone, call the bank. How much cash does this company have in the bank at this point at the end of the year? The bank says X, auditor's tied out. It's beautifully done like that. It's harder to do that with revenue, especially subscription revenue, because you can spread it out over a longer period of time. You can assume that the customer's going to stick longer than they actually do. There's different things you can do, but cash is hard to move around. That's why we like it. Cash flow from operations, the first third of the cash flow statement, $9.4 billion, 9.711. So it's growing, which is good. Growing cash flow. And then, of course, it hits the COVID period, and it's halved again, much like the EBITDA was halved. So that's consistency between the EBITDA and the cash flow from operations. That means the accounting team over in the Mouse House, is doing well, and I like to see that. It's obviously a decline during that period of time, but we're going to write off COVID and say it's one time. We're going to look outside of COVID. 5.7% growth rate annually. It dovetails with EBITDA. It's also growing, which is what we want to see. CAPEX here is largely flat, growing at 3% even with the pandemic. What I liked is their margins. I mean, when you were in there in the 2015, 2018 timeframe, they're making roughly $13 billion of hard jack every single year. Fantastic. They're peeling off $4 to $5 billion to put back into the cruise ships, to build theme parks, to go build film studios, to build out the consumer products division. That's what this cash is for, and you can see that very easily. They can very clearly afford that every single year, and that's an excellent hallmark. You absolutely need a company that produces a large amount of cash, and it can easily afford the entire CAPEX investment, which is very, very good. Then you can see the debt payment. They were borrowing borrowing money here. They got a large $14 billion draw in for COVID because of they needed the liquidity. And then they've been paying that down over time as they get the business under control. As the business comes back online, they will pay that down. When I add these up, this is the cash flow to the equity owner. So this is what we as stock owners are buying. These are the number of shares outstanding, and this is this number on a per share basis. So per share, it looks like they had moved from, and this has the debt payments in it, but basically moved from $4 at a low to $6 at a high, kind of going up. If I take away the debt payments, so you just look at pure business and hold debt constant for a second. Let's just say that that we hold debt constant. You're at 3 and change, and you're at, call it 650. So it's definitely growing. It's definitely moving up. The variability you're seeing here is the movement in debt, the movement of borrowing and paying down debt, which is, in this case, because they have so little debt in the earlier pre-COVID years, I can assume that debt that they borrowed can transfer to us as cash flow investors. Because there's so much more room to borrow, I'm okay with them borrowing money in this instance and buying back stock, borrowing money and paying it special dividends. That's okay because they have plenty of capacity to do so. And then, of course, you got kind of obliterated down here where it's going to be awkward to use these numbers. But the share price itself continues to go up, and you see the large growth in the stock between 2018 and 2019 when the market multiple expanded even though earnings came down. That's basically the market saying, you're telling me that there's a possible subscription business coming out. I'm going to give you credit right away even though you haven't earned $1 on the subscription business. I know it's coming. The stock market's a forward-looking cash discounting machine. So I'm going to increase today's price because I know in these years I'll have subscription revenue. That's exactly what they did. Now, let's go take a look at the subscription business stuff. That's Disney. That's historically. Where are they going in the future? Let's figure that out. So what I did is I pulled the 10Q and I went through and took a look. And there's a couple interesting things here. Let's see if I can pull them out for you, show you on the 10K and 10Q, and then let's model it and see where it goes. Okay, so I've got the 10Q up behind me. It's a little bit of an eye chart. I apologize. I'll move very quickly through this. You can reference it yourself. I'm on page 34 in the PDF of the most recent Disney 10Q. And what this is showing you here is direct-to-consumer, the subscription business, subscription fees for the quarter ending Jan 1, 2022. I use the term December 31st. Jan 1, we're talking one day, but I use the end of month. They've got a different run rate for the fiscal year. Don't worry about it. Basically, December 31st, 2021. That quarter, they generated $3.6 billion of subscription revenue. Same quarter prior year, 2.5, so up $1 billion over the year for 1 quarter's worth of subscription revenue. That's really, really cool. What I like about this is they also break down just 1 page down. This is the millions of subscribers. So here they're giving the subscribers, the number of people subscribed at each of the services. By the way, big shout out for the analyst crew at the Disney House for putting this out. I really appreciate the detail that they're submitting in their 10K. Really, really like that. You've got Disney Plus, domestic, international. You've got all of Disney, ESPN, and Hulu. And they're saying that the Disney itself, Disney Plus, is 130 million monthly subscribers as of Jan 1, 2022. Prior year, 95 million. So up 35 million people monthly year over year. Very, very strong. Then you've got the other groups. Basically, in total, you can add all these up, what I'll do in a second. But what I want to show you is if I continue scrolling down, they take this and they give you historical data. October 1st, July 1st, April, January, October 2020. So they're giving you historical numbers. I'm going to take these and I'll put them in time for you so it's a little easier to see. The last thing I wanted to show you is the actual dollar amount right here. As of January 2022, they're showing you the dollar amount that every subscriber, based on the plan that they have, is paying Disney monthly. So what we're going to do is we're going to take these numbers, we're going to multiply them by this user count right there, and we're going to come up with a dollar amount monthly. We're going to forecast that forward. All right, let's do this. All right, let's take a look at the subscription business for Disney. Here, I'm just copying what they had in their 10Q. Here are all the categories. Here, as of Jan 1, 2022, the number of million subscribers monthly, 129 million for Disney Plus, ESPN is 21 million, and so forth, for a total of 196 million people subscribed monthly for these services. This section is the average price per subscriber for each, and I'm going to multiply them across. So on average, they've got 190 million subs monthly. These subs are paying $8.08 monthly. That is $1.6 billion of monthly revenue in the subscription business, broken down in these categories. Disney Plus is basically a third of that, $572 billion, with Hulu coming in at $530 billion. Nice job, Hulu. So that's $1.6 billion monthly of revenue. I can annualize that. I get $19 billion of annual revenue, which, when I think of that, is mostly profit in my mind, because Disney is already a production house. They're already making movies. They're already doing all the stuff that, say, Netflix is doing, and Disney's releasing them into the theaters. But now they're going to lay on top of all this another $19 billion of annual revenue. That, to me, seems like a lot of it, aside from some cannibalization, because you're not going to the movie theater anymore, you're now sitting inside your home watching TV. But I would think a lot of this would be profit for them, because they already have the engine running, making the content. Netflix's problem is they have to make the content to keep the subscribers. Disney is already making the content. They're just laying on top of the subscriber base. Very, very interesting. And when I look at Netflix, enterprise value to revenue, 5.7 times. I do the same thing for Disney. I get $108 billion valuation just for the subscription piece of Disney, which I think is very interesting. Netflix, we think on the channel, is overrated, overvalued in terms of cash flow. So I think this might be a high number. But nevertheless, it's a good benchmark to have. Let's take a look. If I run out these numbers, what does the subscription business really look like? And this is what I get. Here are the actuals that they were showing. So on the 10Q, when I show you historically, I just went back and every quarter, this is December 31st, 2019, when they kind of first announced. Remember, I told you the market multiple expanded by 60%, went from 10 times to 16 times earnings. That's because they kicked off the subscription program, and people were like, oh my God, it's going to work. Boom, expands the market multiple instantaneously, and basically gives credit for a lot of what you're going to see here was instantly done in 2019 when they announced it. So 64 million people, and it's grown to 200 million, which is what you saw December 31st, January 1st, December 31st, basically the same thing. And this is the growth rate. Notice the growth rate decline. It's one of the reasons the share price has fallen recently is you were growing strongly double digits. You went to 993, got a little bump up to 9, but basically double digit to single digit growth rate, which I think is fair. They're at 200 million subs. If I look over at Netflix, did I put the note? Yeah, Netflix is 221 million subs. That's basically what Disney has, right? 200 million. So I can't imagine their growth rate is going to continue to grow double digits. They basically caught up to Netflix in 2 years. They've done what Netflix has done, took a decade to do. Very, very interesting. Then this $24.20 is the $8.08 monthly times 3 because this is quarterly information. And then this is the actual dollars in millions for subscriber per quarter. Remember I showed you earlier 1.6 billion per month times 3, 4.7 billion per quarter. I annualize it by just adding up the 4, and I've got a business that's $16 billion per year. And then when I run rated, like you saw earlier, we get 19 billion. That's basically me stretching this forward, 19. And the interesting thing here is if I grow this and I say, you know what, subscriber base is going to grow at 2% to 1% annually. Now, that might be a stretch. I don't know if they can grow the subscriber base, but I think for some combination of price appreciation, $8 and move 8 to 850, 850 to 9 over time, or number of bodies watching it. Between the two of those, I think they can grow this. And they're going to take this business from $19 billion, they go all the way down to the bottom, 10 years out. I think it's a $30 billion business, of which 19 is being currently captured. So the delta there is a good $10 billion extra increase from the run rate we're currently experiencing, $19 billion, to $29 billion out a decade is an extra $10 billion of revenue, mostly profit, because they're already making the content, they're already have the infrastructure for the subscribers. If you get one extra subscriber added on, it doesn't cost you anything. It's basically, there's no gross margin. It all passes through to the bottom line. So I think $10 billion is going to drop to the bottom line over the next decade from this business. And what that does, let's figure out what that does with the forecast. Okay, so let's dive right into our forecasting, and we'll see what we think this business is truly worth. All right, let's growth forecast. Every time we're going to forecast, right, it's always an estimate. Nobody knows what the future is, and nothing told us more, nothing showed us more than the pandemic that nobody ever expected. Here we are, 2 years later, Disney's down by 50% on earnings. Stock is up. What's going on? How do we forecast? Who knows? I'm going to throw some numbers out there. It's my guess, math on the table, right? We're just throwing up in this model. What we want to try to do is risk assess this growth forecast with the current stock price to see if it's worth it. That's the trick. So $12 billion, that's me taking this Q, annualizing, I get 12. And I want to look and see where they were at their peak before the pandemic. Well, before the pandemic, I've got 3 years of basically $16, $17 billion of EBITDA. They're run rating at 12 right now, right? So then I'm going to say, okay, it's going to take them another year or two to get back fully, to fully regain the pre-COVID earnings. Then from there, they basically get their historical growth rate with a little extra because they've got the subscription business. And when I look out long term, I'm in a $27 billion range of EBITDA, and that's more than doubling their current level. If I look back historically, what do they do? Here, that's up 60% in 6 years. I think they could double for sure, and with the subscription business as they lean into it, I think there's more growth there for them. How much am I willing to give them credit for? How much am I willing to bake it into the forecast and assume it? Not that much. This is already doubling for a business that's very big, and I think that the cruise lines, the theme parks will take a lot longer to get back to full pre-COVID level. So I'm not going to give them too much credit for it. I will, however, up the enterprise value EBITDA. So we're going to go 16 times, which is what they were receiving when they announced the subscription model here, up from 10, 11 times. So that's a big move. And I'm going to maintain that. I'm going to say it's going to drop from 41 down, fine, because earnings recover. But I'm going to keep the multiple the same. And what that does is it gives me $435 billion enterprise value. I say 2.5 times this debt to EBITDA as we kind of normalize the business a little bit. Outstanding shares remain the same, and I get a $202 price target for the Disney Company out 10 years based on an enterprise value to EBITDA multiple and assuming more than doubling of earnings. More than doubling. Okay, let's take a look at cash flow. All right, here we go, cash flow. Let's forecast this. So what I'm doing here is I'm going to take the EBITDA number that I have, and I'm going to look historically to see what is EBITDA relative to cash flow from operations. What's that adjustment? And cash flow from operations is roughly 70% of what EBITDA is historically on average. So I'll take EBITDA, 70%, less the CAPEX, divide by shares, and I get a forecast for cash flow. 1, positive. 2, growing. I like that. Number 3, it more than doubles, right? 2.7 as it kind of has to grow quickly, going from the $12 billion of EBITDA to 16, normalizes, and then from here it kind of doubles again, which is basically getting back to the cash flow numbers we saw pre-COVID, and then from there we're assuming the kind of normalized growth rate over time, $8.68 long term. I apply a yield to that of 4.5%, and I get a price of $192 a share based on free cash flow for the Walt Disney Company. Okay, now we have a price target. Now we know what we believe we're willing to pay for the stock out 10 years at least. Let's figure out what I can buy the stock for today. So our two forecasts, right? We've got $192 and $200, basically the same. Call it $197 long-term price target for the Walt Disney Company. I look in the stock market today, right now, I can buy as much stock as I want for $132 a share. If I pop this into an IRR calculation, where I got the annualized cash flow that the business is going to generate, that's cash per share. I'm paying $132 for this strip of cash flow, and I'm going to sell this business at $197 out 10 years from now. This is the net cash flow of that investment, and it produces a 9% IRR. An IRR is an annualized rate of return on your money over the 10-year time frame. And what that does is it's kind of a meh. You know, it's close to 10%, which is what the S&P 500 is supposed to do. And I think what that's saying is that the subscription business, even though it's going to grow earnings and revenue, has largely already been baked into the stock price. And it was baked in when the market multiple expanded from 10 to 16 times and never fell as a result of COVID shutting down. Let's put this into a distribution curve. So if I'm here today, $32 at 9%, based on the math behind me, right? This is just a guess, it's math. If you think the forecast is gonna beat what I have in here, then you should be more bullish on the stock. I'm gonna be conservative and say I'll wait for the price to come to me. As price goes up, I'm less interested. But if price comes back down towards $100, I think I'm very interested in this stock. So what we're going to do is we're going to give this stock a meh. Why? Let's review the 5 key attributes. Number 1, top line revenue growth. Yes, it's growing. Number 2, EBITDA. It's growing. Check that box. Number 3, strong free cash flow. Yes, absolutely, cash is strong. Number 4, low debt. Yeah, debt is low. Even though temporarily it's high, it will come down. They're taking care of its low debt. Number 5, well priced. No, I think I'd like it a little bit cheaper. Only because I'm comparing this to other opportunity in the market. I think, looking out at the forecast, there is some question, do they actually get back to full pre-COVID level earnings for the cruise business and for the hotel chain and the parks? I think that's a question. So I'd like to see a little bit more discounting on the stock before we go diving in here. But I did want to touch on one more thing. If you like this type of review, I do teach a course. You can visit my website, cashflowinvestingpro.com, or there's a link in the description below, where I give you this financial model. I teach you how to read annual reports from a CFO mindset, how to fill in the matrix, how to think about building a forecast, and what kind of market multiple is reasonable to assign to a business that you can hold long term and hopefully beat the market. Remember, there are thousands of companies. If you look at the S&P 500, right, there's 500 companies in the S&P 500. If you buy the SPY index, it's an average of all of that. All you have to do is pick, 20 of those companies in the 500 that are going to outperform the index. And doing screenings like this is a simple way to kind of separate the businesses that were going to underperform and going to overperform. And then of the ones that are going to overperform, you go stripping through those, make sure they meet the 5 criteria, make sure you like management, make sure management is invested in the business and owns shares in the business, make sure the industry is growing. All those characters narrow down that and you build a focused portfolio. And that focused portfolio should have a high probability of outperforming the market if you held it for 10 years. And that's it. You make your investment, and you go live your life, and you do not day trade. You invest, you leave the money, and you let that management team work for you. It's a passive growth strategy. It does work fantastically well. There's lots of people that do it. Check out my website, cashflowinvestingpro.com. I also offer one-pages there at the Cashflow Investing Club, where I'm making countless one-pagers and all kinds of different businesses that I publish out there weekly. I can only do one stock here a week, but I can kick out a lot more cash flow sheets into the cash flow club, so check that out. Once again, really appreciate you watching the YouTube channel. Throw a like in the on the video. Give me a comment or what else you'd like to see. Up is going to pop a couple other videos if you want to see other value stocks that I've reviewed. I really, really greatly appreciate the time. Thanks so much for watching. This has been a review of the Walt Disney Company. Thank you. Bye-bye.